All right. Welcome, everyone. Kevin Davey, and welcome to Why Walk Forward Testing is a Must for Algo Trading. Uh, I assume everybody can hear me. If you can't, you're not going to be able to answer in the chat box, right? Because you're not going to know what I'm saying. But I assume people can hear me. And if you can, just type a Y real quick. Yep, people hear me. Okay. You never know. I did it one time where I was going for a couple minutes and I'm like, how come no one's reacting? And then they're like, is there supposed to be a voice? Like, oh man. So, welcome today. I'm gonna try to keep this to an hour, but I might go a little long because there's a lot I want to talk about with walk forward testing. I'm not going to tell you necessarily teach you how to do it. I'm going to teach you about it and why it's so good for it. And this was a 3-day event. This is day 3. 854 people signed up for this. I mean that is pretty amazing. I mean there's multi-speaker events out there that get less than that to sign up, and this was just for me. So I really appreciate everybody being active participants. It's pretty neat that so many people are interested in this algo trading, and I think today is the best webinar of the 3, and hopefully you feel the same afterwards. So, um, by the way, if you did not get an email like 60 minutes before the last couple days, or you did not get links to the recordings, and you're like, hey, you said you'd send a link to the recording. Um, I send those emails through my automated email provider, and there are 23 people out of the 850 who are on my or on that email provider's do not contact list. So I can't send emails to them. So if you say, hey, I didn't get the recordings and you checked your spam, send me an email and I will send it to you just personally without through the automation part. But I just want people to know because a couple people said, hey, how come you didn't send out the links like you said you were going to? And I actually did. It's just if you had been on my email list sometime before and said do not contact, um, then I can't send you anymore. All right. So uh looks like the whole algo trading message the last couple days is getting through. This was on one of the YouTube videos from the recording. Uh I really appreciate that, saying he's learned more from my videos and books than from any other educator. That's pretty cool. And if you think the free stuff is good, there's there's a step up from there, which is really awesome stuff. But I appreciate all the kind words. A lot of people did have emailed me and just said, "Hey, this is great. I'm learning a lot, and today will be no different." So our disclaimer, don't trade with money you can't afford to lose. Past performance is not indicative of future results. Treat all results as hypothetical. And if you follow things in this disclaimer, uh, you're going to be a lot better off as a trader and just educated as a consumer of looking at trading material that's out there, whether they're signals, trading rooms, books, courses, whatever. All right. So today, if you already use walk forward testing, you're going to walk away today with a ton more confidence in it based on what I show you. You're going to be like, wow, yep, I'm doing the right thing. And if you don't use walk forward testing in building your algos or looking at algos, you're going to be like this guy and you're going to say, I really need to be using this. I can't believe I wasn't using this compared to the other methods. And I mean, as you know, if you followed me for any length of time, I don't really exaggerate. I try to tell it like it is, but this sounds kind of out there, like, wow, he's really hyping this up. It's true. This walk forward stuff, it really makes a difference. And you're going to see that today, and you're going to be able to decide it for yourself. All right. So before we start really talking about walk forward testing, let's just talk about historically testing a strategy. And I want to give you like a simple example of different ways to do it so you kind of understand how walk forward fits into just how you back test. And that's all what a back test is, just historically testing a strategy. And I think everybody gets that. And there's different ways to do it. So I want to give you a simple example just to kind of show you what that means. So down here in the lower right, left is where we all kind of start in Loserville. Yeah. Unfortunately, a lot of people stay there and you want to get to profit land. Okay. You want to somehow get to that point. And the question is with trading, how can you do it? Okay. So one approach is what I call the wander method. Okay. And what that would be is, you just kind of, if you were just trying to do this, like on let's say it was two places on a map and you're just going to start going, the wander method would just be like, well, I don't know where I'm going. I'll do this and go around and you just go all over the place and maybe, oh, you almost found it and then you're over here and maybe eventually you find it. Okay. And maybe you don't. But that kind of thing would be if you were doing like no back test, if you were building a strategy with no back test and you'd said, hey, I think a moving average crossover will work. I'm not going to historically test it. I'm just going to get in the car and drive. You know what I mean? I'm just going to start trading it. I have no idea if it's going to lead to profits, but I'm going to try it. That's that's the wander method. You just kind of grasp at things and hope that you get to the profit land. And, hopefully you guys are kind of chuckling at that, but that's what most traders do, especially non-algo traders and especially non-algo traders who never backtest or don't even know about backtest. They do this kind of just silly stuff. They just wander and hope they'll stumble across a method. And if they journal their feelings and, that'll make them profitable, it almost never works. So that is one way to historically test a strategy is in effect no test. It's not the way you want to do it. Okay. So, and a lot of people realize that. And so then they started to say, hey, maybe I just optimize. And the way to think about that, if you're going from one place to another, it's just a straight line, you know. The best, the shortest distance between 2 points, they say, is a straight line. Okay. So that's how people started to do an optimized back test. And it makes sense, right? Straight line, shortest distance should be good. Well, the problem with it is what if there's some obstacles? Now, this is my crude graphic skills of some mountains. So imagine this is a map and these are mountains. And yeah, a straight line would have been good if the land stayed flat, but there's these mountains in the way and you're going to get stuck. And that's really what an optimized backtest does. It assumes it's all flat and hey, if it kept being flat, it would probably work. But you introduce something different into it, like mountains. Oh, well, now it's not so good. Okay. And throughout history, people realize this as they're testing strategies. So then they said, okay, well, maybe we need to verify that there's no mountains. And if there aren't, then we can keep going. And so what that would be doing something like this, where you go part of the way and you say, hey, it's been flat this whole way, so it's probably going to keep being flat. That would be doing like an out of sample, right? Where you do it and then you assume the past is going to keep going and you keep those parameters the same and you check it with a little more data. But again, if you have these mountains in the way, once you get to that tough part, you're screwed, basically. I mean, to be blunt, right? I mean, if you're assuming something and then the geography changes, you're not going to get to where you want to go. And so I know I keep jumping back and forth between like a map and a geography type thing and then talking about trading, but the idea is pretty similar. You know, you don't want to keep going straight here because now the terrain has changed and that just like the markets change. Okay. So that might work, probably won't. And then we get to our last one, and this would be walk forward testing. And what you would do here is you still have those mountains, but what you would do is you do little bits. You do that and you say, okay, well, I can keep going. Oh, I can keep going. And uh-oh, here's something coming up. So maybe I gotta go this way. And then you go this. And you keep doing these little pieces, frequent re-optimizations, and you go around the mountains. That's what that's a simple way to say what Walk Forward does. It takes into account these obstacles that could come in your way and it makes a course correction. Okay. And you do that by retesting over your back test. You don't just run one back test and take the values and use them forever. You don't do it with a one out of sample period. You do it with multiple out of sample periods, and it can get you around the mountains. So that's one reason why walk forward, in theory works good. And I'm going to show you how it actually works with some actual examples. But for those of you who don't know the background of walk forward testing, it's a test technique that has those rolling re-optimizations where you frequently re-optimize. And I don't know if it was originally in this book by Bob Pardo. I know he claims that he's the father of walk forward testing. I don't know. Uh, uh, he certainly popularized it. And in his book, he has a lot of good reasons why it works. Um, and I won't go through each of these, but the point I was bringing up here was probably right here. Effective adaptations to changing market conditions. That's the geography of when you're on flat land and all of a sudden these mountains are up ahead and you didn't know it and now they're there. That's what Walk Forward helps you get around. And it turns out that Walk Forward testing is pretty good at being realistic, at least as far as, hey, if you test something and Walk Forward, when you run it live, it's more likely to look the same. And that's all in this. But, it helps create robust trading strategies. So it's really cool. And it's something you should look at. But why? Why is it so important? Okay. Well, like I said, what most people do is they'll backtest from, say, 2009 to 2024, and they get all this in-sample data where they optimize and get their best parameters, and then they go live with the yellow. Uh, that's out of sample because it's live. And what it comes down to is the blue area really doesn't matter. The blue area does not help you make good strategies. If this was all yellow, that'd be a lot better. Okay, and I'll show you that as we look at different methods. But just think of it this way, that blue in sample, that's bad. The yellow, if it's there's only a little bit, it's bad. But if there's a lot of it, it's good. Okay. So when most people go to optimize, they take all their data, all their rules, they run thousands, millions of iterations, they get the best parameters, they start trading. Okay. That's a simple optimized backtest. And that's what I'm saying. Don't do this. If you have strategies with 20,000 iterations or you do genetic testing, you know, those are bad. If you're doing so much testing that you've got to use this genetic testing, and I know a lot of people use it, uh, that's bad, in my opinion, because it's just you're looking for a needle in a haystack, and it's you're going to find a set of parameters that looks good, but it doesn't have much meaning. So, but a lot of people think, well, hey, optimization is pretty simple. It's easy to do. Why is that bad? Well, let me show you some examples. So take a look at this equity curve. So this is an optimized back test. Um, just I don't have a poll set up, but just yes or no, would you, if this is all you knew and this is the end of 2020, uh, would you trade this strategy? Just type a Y or an N in the chat box just to let me know. If that's all you knew, okay? Now a lot of people are saying no, and they're probably thinking, hey, I'm gonna spring a trap on them. But a lot of people are saying yes. Um, Tom, for example, says, where's the commissions and slippage? That's included in there. So just assume this is trading one contract. It's got all the costs in it. And there seem to be more people saying yes, but there are people saying no. But take a look at this. Does this change your mind that you look at the yearly net profit and out of the last, what, 15 years or so, two have been negative? Okay, maybe it's pretty good. And then you look at profit factor. A lot of people like looking at profit factor, 2.79, and a lot of people are probably like, yes. So, you know, a lot of people, you're kind of a mix, but it seems like more people are saying yes. Um, Tom has a good point. No, because he doesn't know how it was tested. So I'm telling you, it's an optimized back test, okay, with these results, which is most of what you see out there. Okay, anytime people show you things, most of the time they're going to show you optimized back tests. So you might say, yeah, that looks pretty good. Okay, so if you've heard me at all, you've heard me say great back tests do not mean much. And this is a really good example of that because here's what it looked like after it was optimized. So remember, I ran it to the end of 2020. So here's what it's done the last 4 years. Hasn't fallen apart completely, but it's lost money 3 of the 4 years. And that's very typical of an optimized back test. You get a nice looking equity curve of in sample data, but as soon as you go live or out of sample, this light blue can all be considered out of sample. It either falls apart completely or it just slowly dies. This one kind of slowly dies because it looks like, from here to here, it lost a little bit of money, but yeah, it definitely doesn't look like the white part. Okay. So here's another one. You don't have to answer yes or no, but this one again looks pretty good. And through the end of 2020. So this might be a typical equity curve you see. And if it was an optimized back test, which it is, you should really worry about it. So realize what I'm trying to do here is to kind of change your thinking a little bit about making any decision based on the back test curve because you got to know how it was built. So this happens to be an optimized back test, and you go live, and this is what happens. Okay. So you thought you had something nice, but it's because it was an optimized back test. And here's just a third one. And I could do these all day, um, but I think it would get boring after a little bit. This one doesn't even look that great as a back test. And you could say, well, hey, this isn't that good to begin with. And there's what it did, but it was an optimized test, and there's what it did live. So the reality of doing optimized back tests, simple optimization that I showed you, where you run all the data, you don't have any out of sample, you just go live, which is what most people who back test do. That's what I'd call a simple optimization back test. Based on everything I've ever seen, probably 80 to 100% of the time, those strategies underperform the back test. So, your back test has a certain slope. Probably 80 to 100% of the time, that slope is going to be less than it would be. So, what I mean by that is, let me draw it real quick. So let's just say you had your back test looks like that. 80 to 100% of the time, you're going to have something less. So meaning it could look like that, could look like that. There's only going to be a few cases where it keeps going at the same slope and looks just as good. Okay. I mean, that's just the reality of a simple back test. And probably at least half of that time, it loses money or it falls apart completely. So it just collapses. There's only roughly 0 to 20% of the time where that strategy will make money in real time with simple optimization. So, I could definitely have generated some examples that show, hey, you run a simple back test and yeah, it keeps going. And that's what some people out there show you. But the reality is most of the time it doesn't work. It just doesn't work. And, you could say, oh, well, you just cherry pick some examples. Okay, go and do it. I task everybody here to go and do it themselves. Build 25 strategies, optimize them until the end of, let's say, 2020, and then get that best set of parameters and let it run for the last 4 years. And of those 25 strategies, how many did good? How many just fell apart? And you can see for yourself. You'll be able to prove it to yourself. I've already done it, but you know, just realize that things I'm telling you, you can verify them. You don't have to say, well, hey, Kevin said this. I always tell people who I work with that you always want to test and verify things for yourself because that'll give you confidence in it. And maybe you don't find exactly these numbers. Maybe it's a little better for you. Maybe it's worse, but at least you would know then. Okay. Um, this is the bottom line as far as I'm concerned with optimized back tests. They're just BS. They are a joke. And that's why you can't look at an equity curve and really say anything. I mean, I have people send me equity curves pretty regularly, and they'll say, "What do you think about this?" I say, "I have no idea," and they get mad. What do you mean you have no idea? You're supposed to be like really good at this stuff. I said, "Well, I don't know how you made it because that's what matters, not the final result. It's more the process you use to get there. And if you used optimized back tests, they're just BS." Okay. So a lot of people agree, and that's one reason people came up with this out of sample testing. Remember, I showed you this on the Loserville map. This would be where you test maybe 10 years, optimize it, and whatever parameters come out, then you run it live and see how it worked after. And maybe you ran 2020, 21, 22 and said, "Yeah, it looks good." And then or even add 23 and 24. Oh, it looked good the last 5 years. So today I'm going to go live with it. Okay. And look what we're doing. We're adding a lot of yellow, which remember I said that is good. So that is a lot better. Okay. And by the way, for people asking questions, I probably will just get to them at the end. So, unless it's something real simple. Okay. But that doesn't mean you shouldn't ask them. Definitely ask them. All right. So let's try this out of sample testing, this one out of sample period. A lot of people do this. Not as many as just optimize, but this is kind of a step up. Okay. So if you go back to what I was talking for earlier, no testing is like, you know, the bottom of the barrel. And, hopefully you don't even consider that. Then the next step up is, hey, I'm going to optimize. That's like the next step in awareness of this stuff. And you saw those examples of, yeah, that's not so good. Now we're a step beyond that. We're going to do an auto sample verification. Okay. So we're going to optimize from 2007 to 2016. And then we're going to verify the performance for 3 years. So we're going to say, hey, do those parameters that work from 2007 to 2016, do they work from 2017 to 19? So we verify it. And yeah, it works. Great. Then, if it does, then we're going to accept the strategy. If it doesn't, we're going to reject it. And then we're going to run it from 2020 to the present. So let's try that on a few strategies. So here we go. Here is strategy for soybean oil. So that's the optimized test through the end of 2016. So I get my parameters uh, that I'm going to use, and because it looks good. Then I run my out of sample verification, and look at that, 3 years. And you say, man, not only did it work on what I tested, it worked for 3 years afterwards. Wow, that's great. I would agree, right? There's nothing here that says, there's no warning bells that say, yeah, this strategy is probably not going to keep working. I mean, everything says, hey, you tested on the white area, you verified it on this green area, it should keep working, right? That's the thought process. Well, here's what happened. Okay. Um, yeah, it did good. It did good for a little bit. Well, first it started out bad, and then it did good, made a new high. And you're thinking, yep, that looks pretty good. And then it just kind of fell apart. And strangely enough, it started to recover. But it certainly overall, this blue area doesn't look like the green or the white area. Excuse me. It eventually failed. Here's another one. This is on the Nikkei stock index. And again, optimized. It looks pretty good. Here's the out of sample verification. Yeah, that looks nice. I think everybody would like an out of sample period that looked like that, right? And then you go live. And this one, again, it kind of was flat for a little bit, but then it did make new highs and then it fell off. And you could say, okay, well, now you got two examples where it did make new highs. So if I just stop trading it right about here, I'll be good. Well, yeah, if you could actually do that, that's a whole nother subject of when to stop trading this. But if you had just continued on, this one fell apart. Okay. It eventually failed. And then here's one more example. This is the ES. Um, again, looks good. And this one out of sample, yeah, I guess it made a little bit of money, but it kind of just went flat. It didn't really continue. So you could argue that this one didn't even pass the out of sample test. It's kind of borderline the way I would look at it. Yet, look how it did in real time. So if you use this as your criteria and you say, nope, it didn't do good enough, well, guess what? It worked in real time. So I I picked that one on purpose because that one actually looks a lot better in real time than it did during its verification. So it never failed. But hopefully you see that it's kind of a mixed bag with this out of sample. Uh, and here's a fourth one where, yeah, I don't even know as far as an optimized test if that's this, if it's that good. You got this, and then you run it and it goes down and up, and then it's decent. It does make profit, goes from here to here. Uh, and then when it goes live, it's just more of that sort of randomness, although it too made a new high. So, you could say, well, hey, all four examples you showed did make new highs. And yeah, that's true. I don't know if that's something you could rely on. I think it was just these four examples. But, the strategies could definitely make new highs. You can obviously see the difference between optimized testing and this out of sample testing, right? I mean, these strategies, their performance was a lot better. Okay. And yeah, there are only four examples, but I think you can draw at least some little conclusions. The other thing you notice, they still had some sizable drawdowns, and a lot of those strategies eventually did break. Okay. So, I know it's kind of hard to make conclusions based on just what you're seeing here, but I can tell you I'm coming to these conclusions based on a whole lot of other testing I've done. I'm just showing you examples that kind of support it. But optimized testing, that was the first one, usually leads to poor real-time results. And the out of sample testing is much better. And of course, where I'm leading you is, can we do even better than this out of sample testing? And yeah, of course, the answer is going to be yes. It's going to be doing walk forward testing. And I'm not going to go through the how of walk forward testing, but basically you run multiple steps. You do this rolling optimization, and at the end you end up with all this yellow out of sample data to evaluate your trading system. And what it would look like compared to a trading system is 2014 would be right there, 2015 would be right there. So each little piece adds to the equity curve. And that equity curve then becomes what you judge. So look at what you're judging with that equity curve there. It's all yellow data, it's all out of sample. And that's the best data you're going to get. There's no blue data in that last equity curve. And that's why out of sample is so good. You know, you want as much of this yellow as you can. Now we only had a couple days with the optimized back test, anything from today on. With the out of sample approach, we had a chunk of a few years. But this can give us, this looks like what about, well, it's about 10 years with this particular test, and you can get even more. So, depending how you set it up. So that's kind of cool. That's what makes walk forward testing so good because all the data is out of sample. So let's take an example. So I'm going to take those same four strategies that I just showed you with the out of sample test, and I just ran them with walk forward. Okay. And these are actual strategies, by the way. So these are strategies that I potentially trade or do trade. I think I'm actually trading um, let me look, the NQ strategy. Um, Maybe I'm trading a different one, but I am trading, I mean, the NK strategy, the Nikkei. But these are all strategies I could trade. And all the results I'm showing you from 2020 to present was after the strategies were developed. Okay. So that's important. That's what really matters. So when you look at an equity curve anywhere, you've got to know what part of it, if any, was real-time performance. And if you see somebody selling something out there, you've got to assume that none of it's real-time performance, right? I mean, any real time would be from today on if you just happen to come across an equity curve, because otherwise you'd be relying on the person telling you it is. And then, that brings up, hey, are they trustworthy and that kind of stuff. But real-time performance is what really matters. And the results, in this case, from 2020 on, are 1,000 times more important than any back test, regardless how you do it before that point. Okay. So here's the walk forward test. And remember how nice the soybean oil one looked in its white area. This one doesn't look as good. Okay. Yet here's what it did in real time. And yeah, it's making new highs, but it's not perfect. Look at this. Yikes. That'd be tough to trade. You're talking a big drawdown there. But it eventually recovered, kept going, and made new highs. So if you just traded it from there to there per contract, you'd be pretty happy. But the path would be a little rocky, but that's usually how it is. Here's the Nikkei one. And again, the white part of the curve, which for this one's a walk forward test, doesn't necessarily look as good. There's big drawdown, and then there's big drawdowns live, and but it did just recently make a new high, so that one's doing pretty good. And it also looks, this part looks pretty similar to this part. If you draw, let me try to draw a straight line from here to here, and then you draw a straight line from there to, well, I guess well, I don't know where it is. It's probably somewhere like that. Not quite as good, but decent. The slope did decrease, but that's typical. That's what you'll see with live performance. It almost never, as a general rule, does as good as the back test. Here's the ES strategy. Um, Again, making new highs. Looks like it's trading a lot less. These flat periods are just areas where it's not trading. Uh, and then here's one more, the wheat strategy. It was doing good for a while, and then it's kind of faltered a little bit. currently in a drawdown. So, I'm not showing you these cherry-picked examples that show, hey, walk forward always works. These generally work, but they're not perfect. That's okay. But in general, the walk forward tends to keep going in real time, where those other test methods did not. But at the same time, you got to realize you did not eliminate or avoid drawdowns. You saw drawdowns, and I pointed them out on those curves in real time. That's important to remember. There is no way to test that is going to eliminate bad things happening. Drawdowns are going to happen. And, if you think they're never going to happen, um, you're going to be in for a rude awakening, honestly. Okay, so on those four strategies, let's compare the walk forward and out of sample just on the same chart. You kind of have an idea that the walk forward's better, but here's what they look like together. So again, the soybean oil one, where we just did the out of sample testing, its development curve looked a lot better, right? This orange curve does not look as good. Yet, when we went live, the orange curve looks a lot better than the blue curve. So the walk forward is definitely superior there. And let's take a look at the ES system. And again, you could argue, hey, maybe the blue curve is better in the white area, but um, is it better in the blue area? Yeah, you might say so. Although, look at this drawdown. You know, let me highlight that. The drawdown from here to here, that's pretty big, and you didn't get that with the walk forward curve. But you did get more profit. You did get more profit with the walk forward. So that's something to consider. So it's not necessarily, this one's probably a wash, as far as which one's better. You could argue either one. Um, Here's another one. This is that Nikkei index. And this one definitely the walk forward is better because one, it has better profit, and two, it avoids this big drawdown. And then the fourth one, um, again, you have that big drawdown with the out of sample test that you don't have with the walk forward. So um, you add them all together, all four of those together. Here's how they look. And you look at the left real quick, and you'll say, hey, those look pretty similar. They're both good equity curves. And that, by the way, is what you get when you start to diversify. You start to get a smoother equity curve because you're trading multiple strategies. And that's a big thing of what I do is put things together in a portfolio where you're not trading just one strategy. So you get a much smoother equity curve because you're trading multiple strategies. And then when you go live, you can see this orange curve looks uh, a lot better than the blue curve. So overall, you add them all together, the walk forward version is superior. Okay. So what did we learn in all this? Well, for the strategies I showed, okay, the walk forward is definitely better in real time. And that's really the only thing that matters is real time performance. And I'm not trying to kid you and say, well, yeah, this is always going to be the case, because it's not. But my experience is walk forward is much better than just a simple out of sample test. And there's people out there who would disagree with that or say they can't do walk forward or whatever. So, and I know some of these people and they're friends of mine. And whenever I get together with them, we debate this kind of stuff. But that's my experience is walk forward is much better than out of sample. And we're not even talking about those optimized back tests. Those are garbage. Just throw those away. So, and also the no back test, you know, you just completely dismiss those. I'm only talking about walk forward versus out of sample. Okay. And then the second thing that I found, obviously, is the walk forward is better than those optimized tests. And I think most people would agree who've done walk forward. So walk forward testing, what I've seen and what students I've worked with have seen is that it tends to match that real-time performance better than other test techniques. And just so I'm clear on what match means, if you have an equity curve and this is your walk forward test, let me can I change the color here? I don't know if I can. Um, well, anyways, uh, what I mean by match in real time is that is a good match in real time. Okay. Where it's, more or less the same slope. That's what I mean by match. Something that goes like that, that's not a good match. Right? You were doing one thing and then it did something else. So that's what I mean about tending to match. Walk forward seems to match and seems to be more realistic in the general scheme of things. And it's used by a lot of pro traders. A lot of professionals do use walk forward testing. And of course, when you do it correctly, I think it gives you a much more realistic idea of what is going to happen, compared to any other test method. But I'd be remiss if I didn't say, hey, walk forward is not like, you know, the be all and end all. Hey, just do walk forward and your life will be drowning in riches. No, there are drawbacks to it. Okay. One, at first, most people do not understand walk forward and why it's out of sample. And like, for example, I spent a lot of time in my course explaining to people how they should do manual walk forward to understand it, before they just start using it. You want to understand the tool and the whole process because it is difficult to understand. It's also difficult to implement because you have to do things like re-optimizing, you have to set things up correctly. There's different parameters you've got to include, and it makes it much tougher to develop strategies. I could probably create uh, 10 times as many good optimized strategies as I can walk forward, and probably at least 5 times as many strategies with just a one out of sample period as with walk forward. Walk forward's a much tougher test and you get a much higher failure rate. And most people then say, well, hey, that isn't that good. I want to make strategies. I don't want to fail strategies. But remember, the goal isn't how many strategies you pass. It's, hey, are you creating strategies that work in real time? That's why it's good. But that is a drawback. And you have to re-optimize. You got to the keep correcting your course. Remember that map I showed you almost an hour ago of how you got to keep turning to go around those mountains. You've got to keep checking what you're doing and you do that regularly as part of walk forward. So, that's more work. So all these things are bad. There's more. Hey, I've had strategies that you do this re-optimization and it just completely gets out of sync with the markets. And, every long trade should have been a short trade, those kind of things. That does happen with walk forward. And different people will use different tools to do walk forward and they'll get different results. I mean, that's a big thing. If you try to compare results with somebody, they'll say, well, you did it wrong. No, you did it wrong. There's a lot of assumptions to this. And so you got to be consistent in how you're doing things. And you can over optimize. Don't think walk forward testing is a way to avoid over optimization. You can easily screw this up and do things where in effect you've curve fit your strategy. So got to be careful about that. Okay, so if you ever want to know, hey, did somebody use walk forward testing? If you look at the strategy code, you'll usually see this kind of thing. This is TradeStation easy language, but I think you get the point. Well, I hope you get the point. There's these little if blocks. So here there's three of them. In a real walk forward strategy, we'd have a bunch more. And it's got a date range. And it said, hey, if you're between these dates, here's your parameter values. But if you're in these dates, well, now your parameter values may be something different. They may be the same. And then this this one, you'll have these parameters. But if you see that kind of code in whatever you're doing, then you know they probably did it with walk forward testing. And that's in general a good thing. Of course, there's always scammers out there who will fake these results. And, they say, I used walk forward testing and they just made it all up. So got to be careful about that. But, this whole industry of trading education is like um, just watching out for people trying to scam you, isn't it? It's crazy. So even if you see this, you don't necessarily know if the strategy was built correctly, but at least you'll have a better idea about it. Okay, so how do you do it? Once you learn the theory and do it manually a little bit and you know how to do it, there's some various tools out there. I use one called Multi-Walk, and that's not available to the general public. It does, uh, people I work with, though, do have access to it. It's a really cool tool where you just set up your strategy, you set up your parameters, you run it, with different in and out periods and, all sorts of fitness functions. You can do all sorts of things. And you get all these results and it'll tell you things and you can actually get the code. You just click on this and you'll get the code you can put into TradeStation. It's kind of neat. But there are other tools out there too that do it. All right. So let's kind of sum things up. We'll take some questions. Hopefully, I've shown you some examples of walk forward testing and why it's better than optimized testing or out of sample testing. And I get, hey, I only showed a limited number of examples. And if you're still not convinced, you're like, yeah, he just wants us to do walk forward testing. My challenge to you, go and try it. Try it with 25, 50, 100 strategies and see for yourself which one works better in real time. And, feel free to send that to me and say, hey, Kevin, you idiot. I ran 100 strategies and optimized testing was better. So you're a jerk. Okay. Yeah, I'd love to see it. Because that certainly isn't what I've seen for the last 20 years, but hey, I'm always open to anybody who goes through the effort of testing something. And that's the ultimate way to prove things to yourself. I'm telling you what has worked for me in my experience. You might have a different experience. Okay. But I get it. It's tough, it's complicated, it's hard to understand. And then you fail most of your strategies, and then you're like, is it really worth it? Why don't I just do an optimized test or no test? Because I read in this book where this guy, he used to be a doctor, and he decided to start trading, and he knows all this great price action stuff, and he never shows any proof of what he's doing, but he says he's great, so I'm just going to follow him. Yeah, that's a heck of a lot easier than doing this. I don't know if it'll get you anywhere, but that's what a lot of people think. They're looking for shortcuts. This isn't necessarily a shortcut, but if you want to compete out there, there are people doing it, and that's who you're competing against. So remember that. And like I said, don't blindly use it without understanding it. This is all part of having confidence in what you're doing. If you're building algo strategies, you should be confident in this. And you say, well, why? My confidence wouldn't matter if it builds a good strategy or not. True, except when you go live. Because when you go live, and remember I showed you those drawdowns in real time, you're going to start to think, maybe walk forward doesn't work. Maybe Kevin was just, telling me it was working because he wants me to lose. That must be it. Things like that. That's what you got to realize is you want to have confidence that no, hey, I've run this on enough strategies. Yeah, I'm going to have drawdowns, but I believe in this. And that will help you get through the drawdowns. Because really, what trading's about, yeah, it's making profits. That's important. But it's really being able to survive drawdowns. Because the people who can't survive drawdowns quit as losers. Okay. Now, obviously, sometimes the drawdowns are huge, but if you have confidence in what you're doing, you'll believe you can recover from them. Okay, so um, we'll do some questions and answers. Got a bunch here, so it looks like we'll probably be like another 10 minutes, and then we'll do the book giveaway. If you have questions that I didn't answer and stuff here, feel free to send me an email. I can't answer everything. I'll try, but um, just in fairness to people who join my course, they get all the answers. But I try to answer as many as I can here. So, all right. So Tom's saying the thing I've learned is a lot of backtest equity curves don't mean anything. It's the out of sample that's important. Well, yeah. And along those lines, the equity, the backtest curves only mean something if you know how they were built. And he's talking about part of my process uh, during preliminary testing. Uh, is it okay to exclude markets if it doesn't work? You can, or you can still test with them. You don't necessarily have to exclude it. Preliminary testing is something I do to quickly see if strategies have some merit. And that kind of goes back to what I was doing on Tuesday. So if you didn't see that, um, you should go and watch that. Robert is saying, if you start with a simple algo with three inputs, how much time does it take to do walk forward? It doesn't take much at all, especially if you're using a tool to do it, like multi-walk. If you're doing it manually, it could take you a few hours, and um, but that's what I recommend to people just starting out with walk forward is do it manually so you understand why it's out of sample and what's in sample. It'll quickly become apparent, but eventually you can do it and you can do it pretty quickly. Um, M. Richardson, and I know your first name, I forgot it, but it starts with an M. Might be Mark or Mike, I forget. What is the conventional wisdom for saying percentages of in sample versus out of sample? Usually what people do who do that out of sample testing are doing like 75-25. Um, but as you could see with the examples I showed, it doesn't necessarily mean that's all that great. I mean, it can be, and it's certainly better than optimized, but it's not as good as walk forward. Okay, Scott saying, I don't understand rolling walk forward. If each optimization window produces different values at the end, how do you decide which values to use? So you optimize every little section, and whatever values came out to be the best, will you apply those parameters to the next section? So let me just go back real quick. Um, there we go. So here. So step one, what you would do is you would optimize in this case from 2009 to 2013. And let's say you were optimizing a breakout length, and the breakout length is the best one for those 5 years is 10, breakout length of 10. Then what you would do is you would run the strategy in 2014 with the breakout length of 10, and you'd get the results, and that would create that part of the equity curve, and then you'd set it aside. Then you'd go and do your next step, step two. You'd optimize from 2010 to 2014. And let's say that length was 22. You'd apply that to this data, which hasn't been tested, get your results, and that would generate that part of the equity curve. So that's kind of how it works. Hopefully that makes sense. All right. Let me just go back to the question page and we'll continue with questions. Okay. The truth, Mehmet saying, the truth is I understand and apply the testing process and I can't figure out how to proceed in the live step. We take the strategy live. Should we start uh, date we go live? So all you would do is you would just keep doing what you've been doing in backtest. Um, and if you have software that does it, it should tell you, hey, here's the parameters to use right now, and you optimize in February of next year. Um, it's just you just keep rolling with it. Okay, Ron, isn't walk forward kind of an overfitting? I understand the value of it, but using walk forward parameters, different periods, and keep changing sounds like overfitting. It would be, except that when you're changing the parameters, you're applying it to unseen data and you're seeing how it works. So that makes it where it's not overfitting, um, because it's just blind data. And if you do it once, it either works or it doesn't. That helps prevent it from overfitting. Uh, yeah, if you ran the walk forward testing 10 times and each time you adjusted something, then it would be overfitting. So walk forward can still be exploited and abused, but if you do it the right way, you avoid the overfitting. Um, okay, can you explain the pre-live and post-live process? It's the same process. You're just going up to the current date with your walk forward or whatever end date you have. Steve has a question. Can you perform a walk forward on optimized strategies, whereby you then create an optimization of various in and out periods and then perform a walk forward on these, resulting in a curve that has curves inside of curves? Would this be overfitting? Probably yes, because you once you start uh, taking optimized data and redoing things with it, you run the risk of overfitting, curve fitting. The ideal way to do this, and the way I teach walk forward, is you set it all up, you run it once, and it either passes or it fails. You never go back and change any of the parameters of walk forward testing, like the in sample period, the out of sample period, or you don't make any changes to your strategy, because then you're tainting the walk forward part and you're going back to what was said earlier is, hey, isn't this just overfitting? You can definitely make it overfit for sure. Um, Lewis, can you recommend a book that explains in detail how to do walk forward testing? Um, Pardo's book, I think, that I mentioned earlier, I think that has some of it. I have a couple videos on my YouTube channel that'll help you. Um, and I'm trying to think how I learned when I did it, and I think I just kind of got the basics from different places and just tried it out and kind of fumbled my way through it. Obviously, in my course, I teach this and help people out with it. And then once you know it, then you can have software do it. So when I won the trading contest way back when there was no Walkforward software. And so I actually did it all by hand. And that's a great way to learn it. Okay. Klaus is asking, how many inputs do I usually optimize and walk forward? Um, I mentioned this yesterday. I like to keep it uh, a handful. You know, you don't want to do 10 or 20 inputs. And that is a good rule no matter how you're optimizing. Even if you're optimizing the bad way, you don't want to have too many inputs that you're optimizing. Uh, Hakan, is the goal to end up with the same settings for the parameters? For example, in the with the 3-period code for walk forward. No, it's just what Hakan's asking is the goal here to have the same parameter values all the time. No, it really doesn't matter. It's to have the parameters be whatever the walk forward test said was best. So there is no goal with what the parameters should be. SD is saying, what are the reasons for strategies which perform solid in backtest and out of sample fail so dramatically live in your examples? Like technical market changes, something else. Well, part of it is, those out of sample tests that I showed, there was only 3 years of out of sample data. So there really wasn't that much data that you're saying this is a good strategy, where something like Walk Forward might have 10 or 15 years. And that's a lot more data to say, hey, this might keep working. But the disclaimer, past performance is not indicative of future results, definitely holds true. You could have a strategy that worked all the time for the last 100 years, and tomorrow it could stop working. And so obviously then you have to say, oh, well, I've got to take some that into account, take some steps for that to make sure you stop those strategies. But there could be all sorts of reasons. The markets change all the time, and maybe your strategy no longer fits the market. A good example is probably right now, like um, currencies, where currencies the last few years have, pretty much any strategy you have for currencies is probably not doing well because currencies have been a lot less volatile than they used to be. And, that's kind of like a market change, and now strategies aren't performing as well. All right, a few more questions, and then we'll get to the book giveaway. So Ryan's saying if we run a walk forward test and have 10 different sets of settings, which do we use to go live? It's whatever the current one is. And then you'll have to re-optimize soon, and then you'll use that. And you might say, I don't really understand that. Um, that's one of those things when you actually do the test, it'll become clear. Might not be clear thinking about it, but when you actually do it, it'll be clear. And Scott had the same question. What do you go live with? The most recent? Yeah, that's exactly it. Um, Strategy 4 on the comparison chart of portfolio, are you actively trading or is that just an example? So those 4 strategies that made up that portfolio, those are all in my what I call bullpen. It's that I have like 200 some strategies I pick from every month. So some of those I do trade, some of them I don't. I just put those 4 together. So I wouldn't say uh, I can pretty much say I know I didn't trade all 4 of those that whole time period. I might have traded them for bits and pieces. Okay, Klaus, what do you think the walk forward optimizer and trade station? I think it's awful, honestly. It does some things that I think are misleading. One, dead wrong. Two, and I've argued with trade station people and they've said, "Oh no, that's how it's supposed to be." I don't I don't use it. So, and that's one reason why I use this tool called Multi-Walk, which actually a student of mine, Dave, way back when, created, and it works exactly the way Walk Forward should work, at least in my mind. But like I said, every Walk Forward tool makes different assumptions. And um, you can pass walk forward with one tool and fail it with another. Um, Luis is saying if you have 15 years of historical data, how many walk forwards do you usually implement? Well, you got to pick an in sample period and an out of sample period. And I have certain rules for doing that. Um, but the thing not to do is to try a whole bunch of them and pick the best one, because that's just another optimizing. Um, yeah, and Cindy's, what's the difference between trade station walk forward optimizer? Um, like I said, I just think that they do things that I would never do. And a related thing is cluster analysis, which is in the trade station thing. Let me tell you a quick story about cluster analysis, just because Klaus asked it, and it's part of trade stations walk forward. When it first came out, so I was doing walk forward before it came out. What TradeStation ended up doing, they didn't have a walk forward tool. They went out and bought a third party tool that was doing walk forward. And then they hired the guy to, his name was Wooter. I think he was from Europe. I believe he might have even moved to Florida, and he helped incorporate it into their platform and everything. And one of the things it had was something called cluster analysis, where you test a whole bunch of stuff and then pick the best one. And when it first came out, um, I immediately was like, that's just an optimization. That's not going to be good. But and I was trying to tell people that, and nobody, for the most part, most people were like, "Oh, this is great. Thank you, TradeStation. You've made our life so much easier because you've showed us the best way to do walk forward." And the praise and everything lasted about 6 months, and you could go back and look at their trading forum to see this, and then people started to realize that, oh, this isn't so good after all. It's just an optimization. And when you understand that, you realize optimizing a walk forward analysis is no way to go. It's just like optimizing a back test. It's just a little different style of optimization. So I don't use walk cluster at all. Um, Mamet's asking about Monte Carlo. So I didn't really talk about that here, and I don't really want to bring that up, but I do have stuff on my website about it. There's some articles that you can take a look at and some tools. Um, Jan's asking, can platinum be purchased without gold? Um, no. So if you're interested in the platinum course, it it is an advanced course that builds upon the gold course. So you've got to do, what most people do is they just buy the platinum. They start out with the gold material and then jump up to platinum. And he said, will you be having a Black Friday offer? Um, so I don't really want to answer two specific questions about the course right now. Um, is multi-charts walk forward any better? I've used it a little bit, but there's no way it's better than this multi-walk tool. I can guarantee you that, because multi-walk also automates a lot of what the testing process, the whole testing process. But um, at one point I know multi-charts was having, this is a few years ago, they were having a lot of problems with it and people were complaining, but maybe they fixed it. Are there walk forward optimizers out there that are fine according to you? Um, Obviously this multi-walk, but that's only for my students. There is a product called StratOpt. It's what I used to use. So it was the best thing until multi-walk came around. It just hasn't been updated in a number of years. So it's not ac- uh, up to date, but it still is pretty good. So, all right, that looks like all the questions. I appreciate them. Hopefully, you've learned a little bit about Walk Forward, and certainly, I think I've showed enough examples to say make you think, hey, maybe there's something to this Walk Forward, because there really is. Uh, to me, it's like a game changer. Okay. All right. So let's do a book giveaway. It's going to be the second and third person to answer this correctly. So I'm going to go three, two, one, give you the question. Three, two, one. What's the best way to backtest? Okay. No backtest, optimized backtest, out of sample backtest, walk forward backtest. And anybody who gets this wrong, uh, you know, you got to go back and watch it. The answer is obviously D. That's what the whole topic was. But looks like Carolus and Mehmet. Looks like you are two and three. So if you guys send me an email, kdavey@kjtradingsystems.com, I will send you PDF copies of my last four books. Thank you to everybody else. Looks like just about everybody got them right. A couple people uh, had incorrect answers, but hey, it's walk forward testing. That's the best way by far that I've ever seen. And trust me, I wouldn't be doing it. I wouldn't be putting my own capital in my trading if I thought a different way was better. Okay. So, by the way, for those of you, most of you have already got this. If you just send me an email with the subject NQ strategy, you can get this NQ strategy. It's TradeStation. So if you don't use TradeStation, it'll kind of be a pain. Um, if you use multi-charts, most of it will work. Let me know. And there was somebody, Ryan, actually, who's on this call. He fixed it. He had a fix for multi-charts because they use a couple different keywords. So thank you to Ryan for providing that. But you can have this, do with it what you want. It has walk forward code in it, so you can actually see it and understand it. Pretty cool. All right, with that, I will let everybody go. I want to thank you for attending and good luck with your algo trading and your walk forward testing. All right, thanks everybody.